Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This show is brought to you by Bull Realty, my company for assets in Southeast U.S. Buy, sell, lease, commercial real estate, land, multifamily. Give us a call. Reach out to me directly. My email is michael@bullrealty.com. Well, we have another interesting show for you today. We're going to talk about industrial real estate, and we're going to talk about manufacturing. You know, we've all heard that about onshoring, about nearshoring, about manufacturing coming back to the U.S. Is it really happening? And what's that world like? What's the future of it? Please welcome my guest. It's Aaron Halfacre. He's CEO and president and director of Modiv Industrial, and they're a REIT, and they have manufacturing facilities that they own and lease to these companies all over the U.S. Aaron, thanks for being here.
Michael, it's a pleasure. Thank you very much.
Well, first of all, let's just start with that. I mean, it seems like with all the challenges around the world and with COVID, that a lot of companies had problems with getting materials, right, with manufacturing. And there's a lot of talk about bringing manufacturing back to the U.S. or closer. Is it really happening?
You know, it's a good question. We've certainly seen a lot of rhetoric about it in the headlines, and certainly with the election cycle, it's come up. But the reality is, yes, it is. The supply chain disruptions that you talk about. So as early as 2020, we had COVID, and then we had the invasion of Ukraine, and then there's recently been a lot of articles about how the Panama Canal cannot move as many ships as it once did because of the lack of fresh water to pump out of there. We've seen issues obviously in the Red Sea and Suez Canal. And so often our supply chains have been disrupted in a series of times where we didn't think it was going to happen. And over the last 30 years, our model has been predicated on getting everything just in time from somewhere else. And that works for some non-critical items. Yeah. But when you have criticality, it suddenly doesn't work.
Right. Because it seems like a lot of the businesses where just in time, but now a lot of them want it just in case. They just want to have it available, right?
That's right. We focus on the sort of infrastructure-based, real critical components that are manufactured in the U.S. So this could be aerospace, medical, defense, things that we can't do without, right? We're not looking at consumer discretionary types of things that might be sitting on a shelf somewhere that could have taken 6 months to get there, and they might still be 6 months there when you go back. These are things that are really critical for the well-being of our nation, for the functioning of our nation, and are also really designed for things that we don't ever see every day. They're either in their subcomponents in devices, or they're behind walls, or they're under roads. These are types of things that are built and really critical, very physical in their nature, but not something you can buy on Amazon.
Right. And a lot of these facilities seem like they would be really kind of specialty built, right, for these companies. So do you see longer leases than we might typically think about in industrial?
Yeah. So, our average lease that we look at is probably 20 to 25 years in duration. And to your point, they are specialty made, right? These companies, particularly if they're making something that's very critical, they're going to build their facility around the equipment that's needed to build those things. So you could have 2-story, 100-ton presses that might be needed to stamp metals or to shape things. And those require a particular building. You just can't drive them into a 12-foot bay window, right? And so that's part of it. Having a long-term lease speaks to the fact that they're viable, that they're not going anywhere. They're not just a flash in the pan. And typically what we're looking at is they've been around for 25 years or more prior to us signing that new lease.
Yeah. And you guys are a public company, so what, people can invest in your company?
Yeah, we're listed on the New York Stock Exchange, the big board. Been trading for about 2 years now, been public, but not traded for over 6 years. So anyone can buy one share or a lot of shares, get a dividend, that pays on a monthly basis. And that dividend is sourced from manufacturing real estate across the U.S.
Yeah. What about cap rates? Because it would seem that with the longer leases, that might compress cap rates, but then the specific nature of the facilities saying, well, do you need a little higher cap rates? What do you see in relation to kind of similar value ranged industrial properties?
Yeah, so I think we all very familiar that industrial distribution or warehouse cap rates were considerably tight during the low rate environments, right? So it's 3s and 4s and 5s, and we've seen a little bit of softening in those cap rates, but manufacturing always trades at a spread to that. Typically, it could be 200 to 300 basis points wider. Right now, I'd say in the marketplace, we're seeing comfortably things between 8 and 9 caps. These are for 20, 25-year leases. Many of them all have 2.5% to 3% annual increases in rent. I think it speaks to the fact that, these are idiosyncratic. These are very unique properties. You're not going to see one just like it down the street or in the next neighborhood. And so that's reflective of the fact that, they're income producing, but they're not the prettiest looking properties.
Right. Yeah. Not going to drive by and show off to your to your friend.
That's right. Not much to look at.
Well, you can show off to your accountant, though, right?
That's right. Yeah. As long as they produce money and consistently do so, then they're a viable investment for us.
Yeah. What about barrier of entry? Is that impacted the values?
Yeah, your typical manufacturing facility that we're looking at is going to be around $15 million in purchase price and can be as much as 50 or more. And so that typically eliminates the individual 1031 buyers out there. Most of the buying activity we see, either private or public, is from institutional money.
Mm-hmm. Yeah. And then the tenants, once they get into a facility in an area, they're probably pretty sticky and not a lot of places to compete with them, right? I mean,
yeah. So if you think about manufacturing in the United States, and certainly going back to World War II, we were the most dominant manufacturer in the entire globe, right? And our ability to manufacture and to mass produce things really, changed the tide of the war in Europe and as well as in the Pacific. We were a manufacturing stalwart all the way until the late 70s, early 80s. And then during the 80s, we started to outsource. And it really peaked in 1989 when started in 1989 when Eastman Kodak decided to outsource to a third party offshore their manufacturing. And then it really accelerated. And we saw in 1999, early 2000, China started making manufacturing facilities, right? So we all know about this. We all know that everything's being made in China. And, what happened was over the last 30 years, we underinvested in manufacturing in the United States, which means only the things that are still around were things that are very durable, very critical. And what we look for is what's called survivorship bias, right? So ideally, they've been through a number of Fed chairs, Volcker, Greenspan, Bernanke, Powell, which means this manufacturing facility has survived all types of economic environments. It's survived this wave of outsourcing, and they're still building something that's super critical. And because of that survivorship bias, to your point, there's not a lot of competition.
Yeah. And it takes a long time, right, for these companies to pick a location and build a facility. And we talked about when we started the show that maybe it's kind of in recent years where there seems to be more of a push for onshoring or nearshoring. So is this an industry that's going to continue to grow in the U.S.?
Yeah, I think because of the supply chain disruptions and the fact that, we hear a lot about in the headlines right now about chips, right? Semiconductor chips. And most of those are being manufactured in Taiwan, and how there's a big push from the CHIPS Act and the IRA Act to get manufacturing of those types of items back on U.S. shores. But generally speaking, there has been a drive towards, like you said, just in case versus just in time. Corporate managers have said, look, I need these components supplied to me when I need them. So I can no longer rely on them being shipped halfway around the world. So I will pay arguably a little bit more to produce them in the United States, and I have certainty that I have them. And so this trend, which is really kind of started in 2010, and since that time we've seen an addition of over 2 million jobs in the United States. It's projected that we're going to see upwards of $150 billion of capital infrastructure put on over the next decade into manufacturing. I think as a nation, and this could be economic or it could be political or it could be military dialogue that's out there, has identified that we've underinvested in our manufacturing capability and that we need a certain level of critical manufacturing on our shores. And so I think this trend is not just rhetoric. I don't think it's something that is just a flash in the pan. It is here to stay for a foreseeable future until we get strong again in the things that we need to be strong in.
Yeah. our audience is a national audience, and they understand commercial real estate. And one of the things that we do is it's pretty easy for us, if we're in a sector and a specialty, to know what rental rates should be and what comps on rental rates are. But in this type of business, seems like there'd be less to go on there. How are rental rates kind of looked at in your space?
Yeah, no, so underwrite manufacturing is very different than, say, underwriting a dollar store or something else, where I could go into CoStar or I could go into any analytic device and I can look at the 1, 3, 5 circles and understand what the demographics are, and I know what the box is. I've seen the box before. That's a little easier or different way of underwriting, where when you're underwriting manufacturing, you have to start with what industry are they in, right? Do I understand this industry? Is it intuitive to you? For example, last year, probably mid last year, I think it was in Oklahoma, but don't quote me on that, I looked at a luxury pet food manufacturer. Very nice facility. They made pet food and vitamins, and I said to myself, is this consumer discretionary or is this a consumer durable? I couldn't answer that question. I couldn't tell you, will that facility be around 5 years from now? And so that's something we're going to pass on. But in contrast, we acquired the leading manufacturer of guardrails, galvanized guardrails. They've been producing them for 60 years. If you stamp the steel and that wavy thing that you see along the freeway, they dip them in zinc, they galvanize them, they send them out. 90% of the budgets for those are Federal Department of Transportation. And so you have to underwrite the industry first. And then once you've written the industry, you say, okay, I intuitively understand guardrails, they're going to be around. Then you have to underwrite the company. How strong is the company? What's its revenue? How much credit, leverage does it have? Well, how strong is the credit profile? And if you think that's strong, then you've got to say, well, how much are they manufacturing of this good in this facility? Do they have a lot of facilities, and some are underutilized and some aren't as utilized as they should be? You want to make sure that there's high utilization, there's a high demand for what they're manufacturing, but there's also high demand for where they're manufacturing it. And then from there, you can underwrite. This requires you to look at financials. This requires you to look at the industry. This requires you to tour the asset. It is not an easy type of desktop kind of thing. And so because of that, rental rates really depend, right? And you talk about, when someone starts a manufacturing facility, it usually starts from where they started. Like if they grew up in the Central Ohio, they're probably going to start a business in Central Ohio. They don't just pick a spot and go, I'm going to go to Albuquerque, New Mexico necessarily, unless there's a tax incentive or something like that. So then you're looking at the markets where they're at, and manufacturing started all the way back, the colonial period times. A lot of manufacturing started where there were waterways, where rivers and ports, because we use water power for things. And so then manufacturing sprung up there. And then new modern manufacturing replaced the old manufacturing in those same locations. Why? Because those markets, those locales are used to having manufacturing. They've got skilled labor. They're not afraid of it. They don't, there's not NIMBYism, if you will, and they're willing to have it. So you see it in the Rust Belt, you see it in the Carolinas, you see it all in the Southeast. Really strong manufacturing capabilities, but it requires you to underwrite them one by one.
Yeah. So give us an example of a company that may have sprung up in the past that had manufacturing that we might not have thought had it.
Well, and the spectrum of manufacturing is wide. So I've talked about, guardrails, and, that those facilities have been around for nearly 60 years, but there are others that are what we call light manufacturing, or really what they're called light assembly. And the classic story is, you think about a 60s or 70s vintage building, warehouse building, maybe it was over office in the front and it was built for some other person and they're gone. And someone takes this box and they're saying, what's a new trend? And then modern days, it might be assembling, electronic gadgets. Remember those rolling things that kids were, the hoverboards and stuff like that, kids were on, a lot of people were buying facilities, putting assemblies together and doing that overnight. But we've seen those pop up, like a Halloween pop-up store, time and time again. I imagine if you went back in the late 70s, there was a light manufacturing facility for pet rocks, right? Where they just had to keep boxes and straw and put rocks in there, and it was manufacturing.
Right.
But is it, right? And so that's where the nuance comes.
Yeah. Manufacturing rocks. That's a good thing. What might surprise our audience about the space of manufacturing facilities and the sell lease back of these and the dealing with the tenants? And
what would surprise
the complexity, maybe?
I think the fact that, we're so often in our day and age, we're in front of screens, right? We're working in screens, we're watching phones, especially the younger generations, and we're so enamored with technology. we're so enamored about AI now and before, and just everything, whiz bang things. And I think we forget sometimes that some ideas don't have to be whiz bang to be very economically beneficial. That we live in a physical world, that, this microphone stand had to be built somewhere, and it had to be built from materials, and there had to be someone who's skilled enough how to do this. And the entire world we live in is still a very physical world. And everything that is, we're not making things ourselves these day and age, right? We're buying things, right, and they're manufactured. And this is a big industry. And I think people forget about it because it's not in our peripheral view. We can't see it on Amazon, right? We don't really drive by the manufacturing facility. We're driving to the mall or driving to the strip center. And so we don't pay attention to it, but it's a very viable industry. And I think it's been neglected. And certainly for an underinvestment standpoint for 30 years, but the rhetoric you see is here to stay. We're the only pure play publicly traded REIT that focuses on this. Others buy it, but they buy it in a mix of other types of asset classes. So we very much focus on this craft. We believe deeply in it. Just this past Monday, I put out a press release talking about why we care about this. Not only is it economically smart, but we believe in a lot of our real estate out there, particularly in the public institutional side, it's about consumption, right? We have a lot of real estate that's about consuming things, cheap goods, spending hard-earned American dollars on things that maybe we don't need to spend on. And we thought it was a nice change to have real estate where things are made as opposed to things are sold.
Yeah. Well, it makes sense. We have to have it. We need it, even if we don't realize it day to day, right?
Yeah, right.
And as John Westmoreland, one of our industrial brokers, said earlier, sometimes these facilities don't even smell nice or look nice.
They don't. I.M. Pei or some famous architect is not designing it, right?
Yeah.
These are boxes, right? But they serve a real important purpose.
And what's it like when you get to tour? You mentioned that you can't just look online, and I know you were telling me you've just been traveling for weeks here. Yeah. What's it like to see some of these facilities?
Well, the first thing is, you're in a lot of airports, you're a lot of rental cars, you're going to a lot of small places, right? Mm-hmm. People talk about big city, gateway markets and stuff like that. Mm-hmm. You don't tend to find a whole lot of manufacturing there, right? Because over time, if there used to be a lot of manufacturing around the New York City area, but that land became too valuable and they got repurposed and people moved on. That's why you still see manufacturing where there's abundance of land, right? So you're going out to remote places, first thing.
Right.
But when you go, you have to really tour the area, right? So when I go, I'll look for competitors. If there are competitors, I'll also look at other manufacturing facilities in the market just to know what they are. You drive those areas, look at all the comps beforehand. I've done the comps. But then when you get to the facility, usually your goal is to meet with the operations manager. Mm-hmm. You're always happy to meet with the facilities manager, but the real insight comes from the operations manager. They're gonna be responsible for making sure that whatever that widget they're making there is getting produced on time and on budget. And so they're gonna understand how their deliveries of raw goods are coming in. How consistent is that? They're gonna understand how many shifts they need and what's the labor turnover. And labor is a big issue in this market, right? People don't want to work necessarily. And then, how much of it is skilled? Do they need technicians? Do they need things? So you're learning all these things. What equipment do they have? What equipment would they like to improve upon? How would they change stability? Who's their competitor? What do they think about the space? They'll tell you a lot. And you might be walking, these are where you got to wear steel-toed shoes and a hard hat and safety glasses, and you're walking down in a manufacturing facility. You might be there for an hour, and you're going to learn so much that you can't learn on a computer or even talking to a CFO.
Yeah. So you've been in the commercial real estate world for a long time. So you used to wear a lot of suit and ties looking at properties, and now it's hard hats and work.
Yeah, I'm a very, my father was an electrician, and I have a very blue collar upbringing. Mm-hmm. And even though I happen to have done the Wall Street thing, I didn't take to it as well. So I like to dress simple. I like to dress, for instance, I've seen, and some folks will probably relate. I've seen brokers who come from New York looking at a manufacturing facility with me, and they rent the Mercedes, and they come in with their Ferragamos, and the operations manager looking at them like, who are you?
Yeah.
And they don't talk to you. I just, to me, it's really real estate business is a people business. Yeah. At the end of the day, right? We are either housing people or we're providing real estate for people to do some sort of business in it. And we got to remember that there's humans at the other end of this. and that, this is really the heartland of America, and I really just enjoy being with them and really enjoy what they do and how hard they work. And so I just try to fit in as best I can.
Yeah. Most commercial real estate, you really kind of want to look at kind of the end game, the exit strategy, or, when the tenant kind of leaves the property, what's it good for? How do you manage that in your space?
Yeah, it's probably the number one thing you have to focus on, right? Because a manufacturing facility, like we talked about, is a box. It might smell. It doesn't always look pretty. If that manufacturer leaves, it's hard to find the new suitable tenant for it, right? It's just, to be honest, it is. And so your job is to engineer for that to be the lowest probability event, that they're going to stay there. So going back to what I talked about, survivorship bias, multiple Fed chairs, and surviving these things and having something that's durable and that's critical means that they're going to be around. They may not be a fast-growing company. They may not be a high flyer. You're never going to hear about them, on your news feed necessarily, but they're going to be consistently doing something. And if they can do that and you can structure the rent right, they're there to stay.
Yeah.
Right. And so we're spending a lot of time on that, but it happens. And so, a lot of times if you buy something and you got a long lease, you're ultimately, it can be a covered land play. A lot of times we've had things that, ultimately you can't get it reboxed. And so it'll, they might scrape it and put a warehouse on it, right? It's going to be industrial use typically. You're not going to suddenly turn it into, a YMCA or something like that. But it happens. I think no one likes to see an empty building. We're blessed that we're buying them right and focused on it. We're a long-term hold, so we're not looking for the trade. So what we're looking for is avoid that, that event. So that's why understand the industry, make sure they're a strong company, make sure they have a leading share of their business, and then hopefully almost all their business is in that facility. Because God forbid they file for bankruptcy, they're not going to reject that, because that's literally killing the goose that lays a golden egg for them.
You're right. All right. What would you leave our audience with to think about for this space, especially as compared to all the other property types and offers? One thing you were mentioning I thought was interesting, the way you look at it is investors can invest, privately themselves, or, tell us about the kind of three.
Yeah.
Yeah.
If you think about real estate ownership, there's really sort of three primary, where you can do it individually or a small group of individuals, and you own title. And you have full control and you have full responsibility. So the trash, toilets kind of thing, where you got to take care of it, whatever the nature of the real estate is. Yeah. Then there's where you can rest in private real estate funds. And we've seen syndicators do this, and GP, general partners kind of launch funds. And then those funds are finite life, which means they might be predicated on a 5-year hold or a 7-year hold, and they're going to go full cycle. And really most of the way they make money is on the trade, right? I buy it right, I do something to it, and then I sell it right. The public space is permanent capital, right? So that if you have a share of Modiv and I have a share of Modiv, and you need to go sell that to go pay for something else, you can sell it, but the capital's still there, and the property doesn't have to change hands.
Yeah.
And that's the beauty of permanent capital, is it tends to benefit from a lower cost of capital. Banks will finance it over a longer period of time. You can get cheaper rates, and you buy it for a different reason though. But the beauty of these things is, depending on what your strokes are, if you want to own a facility individually, have title, you can do that. But it doesn't always work. For instance, in manufacturing, right? Our manufacturing facilities tend to be $15 million or greater, right? Some of them can be, 9 figures. And, that's eliminating the 1031 buyer market. Typically, that's requiring institution. Now there are funds who do it, but there's trades. And so I don't know if I can get it right personally to pick a company that is so good, that's been around for a long time, but then they're going to move this much in price over a 5-year life, right? I can underwrite that they're going to be around for 20 years, I think, but I can't tell you the price change.
Yeah.
And as a REIT, you're buying it for income, primarily, number one, right? Modiv stands for monthly dividends, and we consistently pay a monthly dividend. You don't have to do anything. You have no responsibility other than just putting the money in, and when you want it, you take it out, right? And so it also comes with appreciation, right? Because as you know, the stock market can fluctuate in value different than what the real value is.
Right.
And in real estate, which is unlike technology or somewhere else, we know what real estate value is. And recently, in the last 24 months, we've seen the REITs probably trade off relative to the private real estate values. And so they've gotten cheap relative to what they're really worth.
Right.
But, for us, I think, the stock market is a way that every employee at one of these manufacturing facilities, if you're just a materials handler and you're just starting out, you can own a share of a company, right? And you can own a share of a company that owns your facility, and you can get a monthly dividend. And if you need to, you can sell it, right? And you can look at it on your phone and you can do it. So I think it's a nice way to do it, but it's just one of the many ways you can do it.
Yeah, that's true. Great. Well, I appreciate you being on the show, Aaron.
Thank you very much for having me.
Good information. Thank you. And thank you for listening or watching. Please share the show. Please connect with us on your favorite social media. And until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For commercial brokerage sales and leasing in the Southeast U.S., contact our show host by email at michael@bullrealty.com. By Commercial Agent Success Strategies, 21 incredible one-hour agent training videos. Learn more at commercialagentsuccess.com. And by Lument. For senior housing, healthcare, and multifamily financing, visit lument.com. For more podcasts and videos, subscribe and visit CREshow.com.